Something just happened in the gold market that should terrify every banker on Wall Street. And I'm not talking about price movements or technical charts. I'm talking about a fundamental shift in how the global financial system operates, a shift that's been building quietly for years, but is now accelerating at a pace that's catching even seasoned market veterans off guard. Let me show you what I mean. Right now, as I'm recording this, gold is trading near all-time highs. But here's what's strange. Normally, when gold hits these levels, you'd expect to see profit taking. You'd expect central banks to slow their purchases. You'd expect the smart money to start rotating into other assets. But that's not what's happening. Instead, we're seeing the exact opposite. Central banks are buying gold at the fastest pace in decades, even at these elevated prices. And that tells you everything you need to know about what they see coming. Think about that for a second. These are the same institutions that have access to economic data before anyone else. They have teams of PhDs analyzing every data point, every trend, every risk in the global economy. And they're choosing to convert their dollar reserves into physical gold at a rate we haven't seen since the 1970s. Why would they do that, unless they knew something the rest of us are just starting to figure out? The answer is simple, but uncomfortable. They're preparing for a system failure, not a crash, not a correction, a fundamental breakdown in how money works. And the evidence is everywhere once you know where to look. Let's start with what's happening in the banking sector itself. Over the past 18 months, we've watched three major regional banks collapse in the United States: Silicon Valley Bank, Signature Bank, First Republic. These weren't small community banks. These were institutions with hundreds of billions in assets. And they didn't fail because of bad loans or fraud. They failed because of something much more fundamental. They failed because the very structure of modern banking is built on a foundation that's cracking. Here's how it works. When you deposit money in a bank, you think that money is sitting there, safe and sound. But it's not. The bank takes your deposit and immediately lends it out. They keep maybe 10% in reserve, sometimes less. The rest goes into loans, mortgages, bonds, whatever they think will generate a return. This is called fractional reserve banking, and it's been the backbone of the financial system for over a century. But there's a problem. This system only works if everyone doesn't want their money back at the same time. It's like a game of musical chairs. As long as the music keeps playing, everything seems fine. But the moment people start to panic, the moment they all rush to withdraw their deposits simultaneously, the whole thing collapses. Because the money isn't actually there. It never was. That's what happened to Silicon Valley Bank. Depositors got nervous. They started pulling their money out. And within 48 hours, the bank was insolvent. Gone. $175 billion in assets. Wiped out in 2 days. And here's the scary part. Silicon Valley Bank wasn't doing anything unusual. They were following the same playbook every other bank follows, which means every other bank is vulnerable to the exact same run. Now, the Federal Reserve and the FDIC stepped in. They guaranteed all deposits, even the ones above the insurance limit. They essentially printed money to make everyone whole. And that worked, for now. The panic subsided. People stopped pulling their money out. But here's what nobody's talking about. That intervention just made the underlying problem worse. Because now, every depositor knows that if their bank gets in trouble, the government will step in and bail them out, which means there's no incentive to be careful about which bank you use. There's no market discipline. And without market discipline, banks have no reason to be conservative with their lending. They can take bigger risks, chase higher returns, because they know if things go wrong, the Fed will print money to save them. This is what economists call moral hazard, and it's poison for a financial system, because it encourages the exact behavior that leads to crises in the first place. Banks take excessive risks. Those risks eventually blow up. The government bails them out. And the cycle repeats, each time getting bigger and more dangerous. But here's where gold comes into the picture. Central banks around the world are looking at this dynamic and reaching a very uncomfortable conclusion. They're realizing that the dollar-based financial system, the system that's dominated global trade and finance since World War II, is becoming unstable, and they're quietly preparing for what comes next. Look at the numbers. In the past 2 years, central banks have purchased over 2,000 tons of gold. That's more than the entire annual mine supply. They're not buying gold as an investment. They're buying it as insurance. Insurance against a dollar crisis. Insurance against a banking system failure. Insurance against the possibility that the financial architecture we've relied on for decades might not survive the next major shock. And it's not just any central banks doing this. It's the ones that matter. China has been accumulating gold steadily, adding to their reserves month after month. Russia has been doing the same, despite Western sanctions. India, Turkey, Poland, Singapore. These aren't fringe players. These are major economies, and they're all moving in the same direction, away from dollars toward gold. Now, you might be thinking, okay, but what does this have to do with me? I'm not a central bank. I don't manage billions in reserves. Why should I care about what these institutions are doing? Here's why. Because when central banks move, markets follow. And when markets move, your wealth moves with them. Whether you realize it or not, your financial future is tied to the decisions these institutions are making right now. Your retirement accounts, your savings, your purchasing power. All of it is denominated in dollars. And if those dollars lose their status as the world's reserve currency, if confidence in the banking system continues to erode, the value of everything you own could change dramatically. Let me give you a concrete example. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold, effectively taking the world off the gold standard. At the time, gold was trading at $35 an ounce. Within 9 years, it had risen to over $800. That's a 2,200% increase. And it wasn't because gold became more valuable. It was because the dollar became less valuable. The purchasing power of every dollar-denominated asset declined dramatically during that period. Now, I'm not saying we're about to see a repeat of the 1970s. The circumstances are different, but the underlying dynamic is the same. When confidence in the currency erodes, when people start to question whether their money will hold its value, they move into hard assets. And gold is the ultimate hard asset. It's been money for 5,000 years. It can't be printed. It can't be debased. It can't be created out of thin air by a central bank. And that's exactly why central banks are buying it now. They see the writing on the wall. They see the debt levels, the deficits, the money printing. They see the instability in the banking system. And they're preparing for a world where the dollar is no longer the unquestioned king of global finance. But here's what makes this moment different from previous crises. In the past, when there was a financial shock, the solution was always the same. Lower interest rates, print more money, bail out the banks. And that worked, because the system still had credibility. People still believed that the dollar was sound, that the banks were safe, that the government could manage the economy. That belief is eroding. You can see it in the data. You can see it in the behavior of sophisticated investors. You can see it in the gold purchases by central banks. The trust that held the system together is breaking down. And once trust is gone, it's almost impossible to get back. Think about what happened in 2008. The financial crisis nearly brought down the entire global banking system. Lehman Brothers collapsed. AIG had to be bailed out. The government had to inject trillions of dollars into the economy just to keep things from falling apart. And it worked. The system survived. But at what cost? The Federal Reserve's balance sheet went from less than $1 trillion to over $4 trillion. Interest rates went to zero and stayed there for years. The government ran massive deficits to stimulate the economy. And all of that money printing, all of that debt, it didn't disappear. It's still there. It's still in the system. And it's created distortions that we're only beginning to understand. One of those distortions is in the banking sector itself. Because when interest rates are at zero, banks can't make money the traditional way. They can't borrow at 2% and lend at 5%. The spread disappears. So they have to take more risk. They have to reach for yield. They have to invest in longer-term bonds, riskier loans, anything that generates a return. And that's exactly what they did. Banks loaded up on long-term treasury bonds thinking they were safe. After all, treasuries are backed by the full faith and credit of the United States government. What could go wrong? Well, here's what went wrong. When the Federal Reserve started raising interest rates to fight inflation, the value of those long-term bonds collapsed. If you bought a 10-year treasury bond yielding 2%, and then interest rates go up to 5%, your bond is suddenly worth a lot less. Because why would anyone buy your 2% bond when they can get a new one paying 5%? This is exactly what killed Silicon Valley Bank. They had billions in long-term bonds that had lost value as rates rose. And when depositors started pulling their money out, the bank had to sell those bonds at a loss. And once they started selling, everyone realized the bank was insolvent. Game over. Now, here's the terrifying part. Silicon Valley Bank wasn't unique. Almost every bank in America has the same problem. They're all sitting on unrealized losses in their bond portfolios. The FDIC estimates that banks are holding over $600 billion in unrealized losses right now. $600 billion. That's more than enough to wipe out the capital of dozens of major institutions. So why haven't we seen more bank failures? Because the Fed stepped in with a new lending facility. They're allowing banks to borrow against their bonds at par value, not market value. Essentially, they're pretending the losses don't exist. They're papering over the problem with more printed money. But this can't go on forever. At some point, the market will force a reckoning. Either interest rates come down, which would reignite inflation, or banks have to recognize their losses, which could trigger a wave of failures. There's no good option here. It's a choice between bad and worse. And this is why gold is sending a warning signal. Because the people who understand how the system works, the central bankers, the sovereign wealth funds, the institutional investors, they're looking at this situation and realizing there's no easy way out. They're realizing that the next crisis might not be something the Fed can solve by printing more money, because at a certain point, printing money becomes the crisis. Let me explain what I mean. When the government runs a deficit, it has to borrow money. It does this by issuing treasury bonds. And who buys those bonds? Well, it used to be foreign central banks, especially China and Japan. They would take their trade surpluses and recycle them into treasuries. This kept interest rates low and allowed the U.S. government to borrow cheaply. But that's changing. China is no longer accumulating treasuries. In fact, they've been reducing their holdings. Japan is facing its own debt crisis and can't keep buying at the same pace. So who's picking up the slack? The Federal Reserve. They're buying treasuries with newly printed money. This is called monetizing the debt, and it's exactly what leads to currency debasement. Here's the problem. When you print money to buy your own debt, you're essentially creating money out of thin air. And when you create money out of thin air, you dilute the value of all the existing money. This is inflation. Not the kind of inflation you see in consumer prices, although that happens too, but monetary inflation, the expansion of the money supply. And when the money supply expands faster than the economy grows, each unit of currency becomes worth less. This is what happened in Weimar Germany in the 1920s. The government printed money to pay its debts, and the currency became worthless. People needed wheelbarrows full of cash to buy a loaf of bread. Now, I'm not saying we're headed for Weimar-style hyperinflation, but I am saying that the dynamics are similar. When governments can't fund themselves through legitimate borrowing, they turn to the printing press, and that never ends well. And this is exactly what central banks are worried about. They're looking at U.S. debt levels, which are now over $34 trillion. They're looking at annual deficits that are approaching $2 trillion. They're looking at a Federal Reserve that's trapped between fighting inflation and supporting the banking system. And they're concluding that the dollar might not be the safe haven it once was. So they're buying gold. Not as a speculation, not as a trade, but as a strategic reserve. A form of money that can't be printed, can't be debased, can't be manipulated by any government. And when central banks buy gold, they're making a statement. They're saying, we don't trust the current system to survive the next crisis. Now let me pause here for a second because this is important. If you're sitting on $100,000 or more in retirement accounts, you need to understand how this affects you. Most retirement accounts are invested in stocks and bonds, and both of those assets are denominated in dollars. If the dollar loses value, your retirement loses value. Even if the stock market goes up in nominal terms, you could still be losing purchasing power. This is why a lot of people are looking at gold IRAs. It's a way to get physical gold into your retirement account without triggering taxes or penalties. I put together a free guide that explains how it works. It's in the description below. Covers the basics, the rules, what to watch out for. If this is something you're thinking about, it's worth checking out. Anyway, back to what's happening in the banking system. Because the gold warning isn't just about currency debasement, it's also about the structure of banking itself. And this is where things get really interesting. Modern banking is built on confidence. Confidence that your deposits are safe. Confidence that the bank will be there tomorrow. Confidence that the system works. But what happens when that confidence breaks? We got a glimpse of this during the Silicon Valley Bank crisis. Within hours of the news breaking, people were lining up to withdraw their money. Not just from SVB, but from other regional banks too. There was a contagion effect. People started wondering, if SVB can fail, what about my bank? And that fear, that loss of confidence, is incredibly dangerous. Because in a fractional reserve system, banks don't have enough cash to pay everyone back at once. They're relying on the fact that most people won't ask for their money at the same time. But if everyone does ask, the bank fails. It's that simple. And in the age of digital banking, A bank run can happen in hours, not days. You don't need to physically line up at the branch. You just log into your app and transfer your money out. And if enough people do that simultaneously, the bank is done. This is what keeps central bankers up at night, because they know that the banking system is fundamentally fragile. It's built on leverage, on confidence, on the assumption that things will keep working the way they always have. But assumptions can be wrong, and when they're wrong in banking, the consequences are catastrophic. Now, the traditional solution to a bank run is for the central bank to step in as lender of last resort. The Fed provides liquidity, guarantees deposits, does whatever it takes to restore confidence, and historically, this has worked. But there's a limit to how many times you can do this before people start questioning the value of the currency itself. Think about it. Every time the Fed bails out a bank, they're creating new money. And every time they create new money, they're diluting the value of existing money. At some point, people start to realize that their dollars are worth less. And when that realization spreads, you get a currency crisis on top of a banking crisis, and that's a nightmare scenario. This is exactly what happened in Argentina. The government kept bailing out banks, kept printing money, kept trying to maintain confidence. And eventually, people lost faith in the peso. Inflation spiraled out of control. The currency collapsed, and ordinary people saw their life savings evaporated. Now, the United States is not Argentina. We have the world's reserve currency. We have the deepest financial markets. We have institutions that are much stronger. But the principles are the same. If you abuse the privilege of having a reserve currency, if you print too much money, if you bail out too many banks, eventually the market loses confidence. And when the market loses confidence in the dollar, there's no cavalry coming to save us. Because we are the cavalry. This is why the gold purchases by central banks are so significant. They're not just hedging against inflation. They're hedging against a loss of confidence in the entire dollar-based system. They're preparing for a world where the dollar is no longer the unquestioned global reserve currency. And if that happens, everything changes. Let me paint you a picture of what that world might look like. Right now, oil is priced in dollars. If you're a country that wants to buy oil, you need dollars to do it. This creates constant demand for dollars, which supports the currency's value. But what if oil started being priced in other currencies? What if China and Saudi Arabia started settling oil trades in yuan? What if Russia and India started using rupees? This is already happening. We're seeing the early stages of de-dollarization. Countries are setting up bilateral trade agreements that bypass the dollar. They're creating alternative payment systems that don't rely on SWIFT, the dollar-dominated messaging system that banks use for international transfers. They're building the infrastructure for a post-dollar world. And every time they do this, every time they move away from the dollar, it reduces demand for dollars. And when demand for dollars falls, the value of the dollar falls. And when the value of the dollar falls, everything priced in dollars becomes more expensive. Your groceries, your gas, your electricity, everything. This is the real threat. Not a sudden collapse, but a gradual erosion of purchasing power. A slow-motion crisis that unfolds over years, not days. And by the time most people realize what's happening, it's too late to protect themselves. But here's the thing. The people who understand this, the central banks, the sovereign wealth funds, the ultra-wealthy, they're already protecting themselves. They're buying gold. They're buying real assets. They're moving out of paper claims and into things that have intrinsic value. And they're doing it quietly, without fanfare, because they don't want to trigger a panic. But the evidence is there if you know where to look. Gold prices at all-time highs, even as real interest rates are positive. Normally, gold struggles when real rates are high because there's an opportunity cost to holding it. You could be earning interest instead. But right now, people are willing to accept that opportunity cost because they're more worried about the risk of staying in dollars. And it's not just gold. Look at other hard assets, real estate in prime locations, farmland, energy infrastructure, anything that produces real value, that can't be printed or debased. These assets are being accumulated by people who understand that we're in the late stages of a debt supercycle. And when that cycle ends, paper wealth evaporates. Only real assets survive. Now, I want to be clear about something. I'm not saying the dollar is going to collapse tomorrow. I'm not saying you should panic and convert everything to gold. What I am saying is that the warning signs are there. The system is under stress. The solutions that worked in the past might not work in the future. And the people who are in a position to know, the central bankers, are taking action to protect themselves. So what does this mean for you? It means you need to think about your financial situation differently. You need to ask yourself, how much of my wealth is tied to the dollar? How much is in paper assets that could lose value if confidence in the system erodes? And what am I doing to protect myself? For some people, that might mean holding some physical gold or silver. For others, it might mean investing in real assets, businesses, things that produce cash flow. For others, it might mean diversifying internationally, holding assets in different currencies and jurisdictions. There's no one-size-fits-all answer. But the key is to recognize that the risk is real. Because here's what history teaches us. Financial systems don't last forever. The gold standard ended. The Bretton Woods system ended. Every monetary system eventually reaches a point where it can't continue in its current form. And we might be approaching that point now. The debt levels are unsustainable. The banking system is fragile. The currency is being debased. And the people who run the system know it. That's why they're buying gold. That's why they're preparing for what comes next. And that's the warning that gold is sending right now. It's not a warning about price movements or technical levels. It's a warning about the system itself. A warning that the financial architecture we've relied on for decades might not survive the next major shock. And when that shock comes, and it will come, the people who prepared will be fine. The people who didn't will lose everything. So pay attention to what central banks are doing, not what they're saying. Watch where the smart money is moving. And ask yourself, am I prepared for a world where the rules change? Because that world might be closer than you think. The gold market is telling us something profound right now. It's telling us that the era of unlimited money printing, of endless bailouts, of kicking the can down the road is coming to an end. The bill is coming due. And when it does, the only question that will matter is whether you positioned yourself to survive what comes next. This isn't about fear. It's about reality. The system is sending warning signals. The question is whether you're paying attention.